All right, so here we are again. Now, let's see. I believe this week we're doing the sample midterm. Let me just double check. That's right. Okay, sample midterm it is. All right, let me get it open. Okay, so let's see. Yes, this is the one. All right, let's get through this. And then I can actually post the actual midterm, which you can work on when you get an opportunity. And then let's say you could probably have a week to do it. That sounds about right. Maybe a week and a half if it spills over to the next weekend. It's fairly long. No, it's not. This is the sample midterm. The actual midterm isn't quite this long, but all right, I'll tell you what. Why don't we do this? Let me look at the calendar. All right, so today is the 25th. So that means the following Monday, it looks like it would be the 6th of April. Let's see. April 2021 calendar. The 6th. All right, let's do this. Let's have the test be due by Monday the 6th. First, let me go to Blackboard right now and put an announcement so that everybody knows. I don't want to forget about this. Let's see. Let's see, where are we? Here we go. All right, so in the course readings, yeah, so as soon as we're done tonight, I'll post the actual midterm. And then let me make an announcement right now. I believe, let's see, I don't remember if, let me just check something real fast. Oh, so okay, a lot of my classes, I have 2 midterms. It looks like this one, we do not, but there is look at this, problem set. So I'll tell you what, why don't we do this? Instead of having a second midterm, I'll create a problem set for, let's say, next week or the week after that can count for problem sets. Then we'll have the midterm and the final. We'll have to discuss this currency wars paper very soon, and class participation. Well, that's understood. So, all right. So let me just make this announcement. The midterm will be due on Monday, April the 6th at midnight, just to make it clear, at midnight. Okay, so that's quite a bit of time. You should have no trouble whatsoever getting that done. It's not nearly as long as the actual sample midterm because it can't be. This was meant to be done in a classroom setting where we don't have all night. Okay, like a couple of hours max. All right, so that way there's no doubt about that. So let's go back here and start the process. Now, of course, you see that there are 18 fill-in questions. And here, in these cases, most of these can be answered with a few words or maybe a sentence, possibly a short equation or maybe a number. And then down here, of course, these are the problems that we've been working on. These do, in some cases, require graphs. So what I recommend that you do is write this out on a piece of paper, or you could type. There's a lot of it that can be typed, but ultimately it needs to be in either a Word document or possibly written down on a piece of paper. There's 2 options, 2 or 3 options, I should say, for getting it back to me. Number one, if you own a printer, it probably has a scanning function, which you can use to turn it into a PDF file. And that's great. If not, you can use your cell phone camera to take pictures. Now, there's this other product that I've been made aware of, but I've not had a chance to confirm it myself, how well this thing works. And let me just go get the name of it. It's called, all right, let me, I'll put this in the chat room. How about that? Genius Scan. Hold on one second. Of course, it went there. It's called Genius Scan. Now, I know that it's free. It's available for the iPhone. I'm not sure about the other phones. It's definitely free because I have a copy of it right here, which I downloaded only because one of the undergraduates recommended it to me. But I don't have the slightest idea how to use it. But they have told me that the quality is likely to be better than if you just take pictures of it with your phone. So if you want to, you can experiment with this thing. If not, well, then don't worry about it. But, you know, I would at some point like to find out if it works very well or not. So you can try that as a third option. So again, you can scan this with a PDF into a PDF file. You can take a picture of it with your cell phone, or you can try this Genius Scan feature. Either any way you look at it, just make sure that everything's legible. That's really the biggest risk when we do this. It has to be legible. All right, so sometimes you don't realize it. When you're taking a photograph of a document, sometimes there's a lot of glare and it's hard to see it. But, you know, if you just be careful with it, it should be okay. All right, then let's get to it. Here's the sample midterm. Let me just do one little thing here. Today's the 25th. And let's do this. Now, let's get first to the fill-ins, which are very straightforward. And so for the first one, if Toyota produces cars in the United States, which it certainly does, in which country's GNP would the value of the cars be included? Well, now remember what GNP means. It means within the borders of a country, okay? GDP means the citizens of a country. So, therefore, it will be counted in Japan's GNP because it is a Japanese company. All right, so again, N, national, means it is based on wherever this, oh, wait a minute, hold on a second. It's being produced in the United States. That's right, yes, because GNP only focuses on citizenship. It doesn't really depend on location. It depends exclusively on citizenship. So this would definitely be Japan. Okay. All right. Now, in the national income and product accounts, which is where we find the balance of payments data, what is the difference between durable and non-durable goods? Okay, so here we can say that durable goods are meant to last 3 years or longer. Non-durable goods, obviously, are meant to last less than 3 years. So the cutoff point between the two is 3 years. All right, now again, in the national income and product accounts, how is new spending on new housing classified? That would be investment spending, not consumption spending, but investment spending. It sounds strange, but that's where it belongs. Because I guess they look at housing as the ultimate investment, and so it goes into that category. Okay, now the algebraic relationship between GNP and GDP, well, we can think of it as NP is GDP plus what we call net income receipts. Now, of course, remember, income means land, let's say rent on land, wages to labor, interest on capital, that type of thing, returns to the factors of production, or what we're actually talking about here. So if a foreigner earns dividends from an American stock, or if an American receives profits from an investment in the UK, those all get put into this category. And so net means how much is coming into the United States minus how much is going out of the United States. And so that number can be either positive or negative, which means the GNP can either be greater to, less than, or equal to GDP. Beautiful. Now, if an American citizen buys a British bond, where would this transaction appear in the balance of payments? Okay, so this one, specifically, it appears in the financial statement. But if you want to be more specific than that, it is considered to be U.S. portfolio investment. So in other words, an American is buying a foreign financial asset. We think of that as portfolio investment in a foreign country. But it ultimately appears in the financial statement. Now here, a French importer is buying California wines. That belongs in the current account. But specifically, this is an export of a good. Okay, so it doesn't, the question doesn't say that you need to be quite that detailed. Really, all we want to know is which account does it belong in. The current account, remember, is where the trade is of goods and services, as well as net income receipts. The financial account is where we have flows of investments between countries. Beautiful. Now, foreign direct investment. Okay, well, this basically, this refers to the purchase of foreign business enterprises, I guess we'll say, or real assets, such as real estate. Okay, or foreign real assets, such as real estate. In other words, this is meant to be distinguished between U.S. foreign direct investment, which is actual physical goods and services, as opposed to portfolio investment, which refers to financial assets like stocks and bonds. So if an American company buys out a foreign company, or if an American company decides to build a new headquarters in a foreign country, that would all go into this category. All right, so in other words, the purpose of this is to distinguish it from the purchase of foreign financial assets, which belong in the category U.S. portfolio investment. But both of these belong in the financial statement or financial account. All right, now, moving on to foreign exchange, we have the exchange rate between the dollar and the pound is $1.50 per pound. The exchange rate between the yen and the dollar is 110 yen per dollar. What is the cross exchange rate between the yen and the pound? Quoted as yen per pound. All right, well, there's only two things we can do. We can multiply and we can divide. So the question is, what should we do? The answer is do whichever one results in the correct units being left over at the end. So in other words, if we take our $1.50 per pound and multiply this by 110 yen per dollar, you notice that very conveniently, the dollars cancel each other out. The product of 1.5 and 110 is 165. So we wind up with 165 yen per pound. Although you can certainly write it like this as well. I think that writing it in this way as ratios makes it easier to see when you're doing this correctly. In other words, if I had decided to divide, well, I would have had the wrong answer, but I would have wanted to see why. Okay, so this way I can see that the units drop out that I don't want, and I'm left with the ones that I do want. All right, now, suppose that an American tourist traveling to London is given the following quotes for the exchange rate between the dollar and the pound. So the value of the bid-ask spread is very simple. We take the larger number and subtract the smaller number. And if you take out your calculator, you'll see that the difference between those two numbers is 0.0212 dollars per pound. Or in other words, 2.12 cents per pound. That's the bid-ask spread. And it's nothing but the difference between the two prices. Now, based on the previous question, if the tourist uses $10,000 to buy pounds, how many pounds will he or she receive? So that's a tricky one, because remember, the tourist is buying the pounds from a dealer who's trying to make money on every transaction. So the tourist will end up with 10,000 pounds. Actually, let me write this out by hand, because I want you to see how the units cancel out. We've got $10,000. So the tourist will pay the higher of the two prices, of course. Now here, algebraically, I can rewrite this as $10,000 times 1 pound per $1, 50.36 cents. So again, the dollars cancel out. And so if you take your calculator and divide 10,000, 10,000 divided by 1.5036, that's going to leave us with 6,650.70. That's how many pounds the tourist will end up with. But now the tourist comes back from London and still has 5,000 pounds left that hasn't been spent. It's not going to do any good to keep pounds in the United States. So the tourist will sell them back to the same dealer. And this time, though, the price that is relevant is not the 150.36, but the 148.24, because when you're the buyer, you're always the one, or the seller, the dealer always gets the better price. It's like the house always wins in casinos. It's the same thing here. What's different, though, is that we're not going to actually divide this time. We're going to multiply, which makes perfect sense because we're reversing what we did earlier. And you notice how very conveniently the pounds cancel out. So when you multiply these two numbers together, 5,000 times 1.4824, you'll end up with $74.12, $7,412. Beautiful. All right. Now, how about this one? An appreciating dollar will have what impact on the U.S. current account balance? This will worsen the current account balance. And if you want to go a little further, you can say because it will reduce U.S. exports and increase U.S. imports. You don't actually have to do that, but you might want to, just to explain why this is happening. All right, now, according to the asset approach to the exchange rate determination, if investors become more pessimistic about the dollar's future value, does the dollar appreciate or depreciate? Okay, so remember how this works. you have this is your starting point, which we then rearranged algebraically to solve for E. So this is where the equilibrium exchange rate comes from. So from here, we can figure out the impact of any change that we need. So here, for example, they're asking us about investors becoming more pessimistic. And so what that means is that EE is rising. In other words, investors expect a weaker dollar in the future. Okay. So therefore, all we have to do is look at this ratio. So since the numerator of this expression increases, the entire ratio increases. And therefore, E increases, which means the dollar depreciates. So now you may have remembered this from before. We mentioned this, that when people become pessimistic about a currency, that by itself is enough to make it depreciate. And so just remember that when we think the dollar will get weaker, it will get weaker because we're selling it when that happens. And if we're more optimistic about the dollar, it becomes stronger because then we go out and buy it. So it becomes basically what we call a self-fulfilling prophecy. It happens because we expected it to happen. Now, if something changes, I mean, maybe everybody will change their mind and say, well, we're crazy to do this. The dollar should get stronger. But right now, at this point in time, the dollar will get weaker just because of this increased pessimism. That's all it takes. Okay, currencies are heavily affected by market psychology. Okay, now according to the same approach, if a foreign central bank engages in contractionary monetary policy, should the dollar appreciate or depreciate against that currency? All right, well, we'll use this as our starting point again. So what's happening here is that a foreign central bank engages in contractionary monetary policy. So that means that the British interest rate goes up. That's what contractionary monetary policy does. It raises the rate of interest. So if I increase that in this denominator, we don't even need numbers to prove it, although we could make some up if we wanted to. But what's happening is that you are now, when our pound increases, we are subtracting a larger number in the denominator so that the denominator falls and the ratio rises. So just from a purely algebraic perspective, we're saying that this is going to cause E to go up. Okay, so in other words, based on this logic, E increases, so therefore the dollar depreciates. Now, you can also try to explain this in economic terms rather than purely algebraic terms. You could also say, well, listen, if the foreign country, this also works, the foreign country, in this case, if the UK raises interest rates, then the pound becomes relatively more attractive to investors than the dollar. Investors will shift funds from dollars to pounds, and this will cause the dollar to depreciate. All right. So for the same exact reason, I mean, it's the same idea, but here we're using just algebra, and here we're using economic logic. Either one is fine. Up here, it's a little bit trickier. That's why I use the algebraic approach. But I think it should be clear that if investors are pessimistic, I'll add that here too. If investors become pessimistic about the dollar, they will sell it and it will depreciate. So that's the economic reasoning. All right, so whenever there's, either one is fine. Whether you want to use pure economic reasoning or algebraic reasoning, it's fine. Either way, you'll get the same result. Okay, now the monetary base. There's really two ways we can define it. There's the one that we use most of the time, and then there's the one we use less often. The monetary base can be defined as, number one, reserves in the banking system plus currency in circulation, or domestic assets, let's say domestic and foreign assets held by the Fed. Both of those will give us the same number. All right, now the federal funds rate, this is the rate at which banks lend funds to each other, or I should say, not funds in general, just reserves to each other. All right, because we know that sometimes banks fall short of their targets, and rather than borrowing from the Fed, which could be very expensive, they'd probably rather borrow from each other. Okay, very good. Now, an open market purchase entails a purchase of treasury securities from the banking system by the Fed. Since the Fed credits the accounts of these banks that have sold treasury securities with reserves, this makes it possible for the banks to lend more, which ideally will stimulate the economy. All right, so maybe all of that wasn't absolutely necessary, but the idea here is that they're buying treasuries from the banking system. That's all you need to know. But the net effect of it is that it puts reserves into the hands of the banks. They can lend them out, and that typically helps drive down interest rates, and that causes the economy to get stronger. Now, if GNP rises, what happens to the real demand for money? All right, so let's remember what that looks like. We had a graph where we had on the vertical axis the nominal rate of interest. Here we have the real quantity held of money. Here's our money demand curve, which you remember is written out as LYR. The Y has a plus over it, the R has a negative, because when real GNP, the Y increases, the entire curve shifts to the right. Okay, so let me draw this slightly differently. I'll call it Y1. This will be Y2. Okay, so therefore this represents an increase in GNP, and you can see the real demand for money increases. Okay. Now we're ready for part 2. So now these are problems. Now, at least 2 of these are arbitrage problems. We have to be careful with them. So let's look at the first one. We have 3 exchange rate right off the bat. This is triangular arbitrage. All right. In fact, it says it in the bottom here. So here's what we're going to do. I will show you, and this is not the only way to do it, of course. In my graph, I have dollars in the bottom left-hand corner. I have yen up here. And I have pounds down here. Now, I could have just as easily done something different, but what really is important in these cases is not the ordering of the circles, but which direction should you go in. So we have this US trader who starts with $1 million and, of course, wants to make money with triangular arbitrage. But first, let's confirm that there are opportunities here to earn money. How do we do that? What we have to do is take the 2 exchange rates that involve the dollar and in this case we're going to multiply. And why are we doing that? We want the dollars to cancel out. We want to have a quote in terms of yen per dollar, or per pound rather. Okay, so this is the implied, we'll call it, cross exchange rate. But look what we got. This is the actual quote. So you can see there's a discrepancy, and that implies that there are arbitrage opportunities. The question is, how do you take advantage of them? If these were equal to each other, we'd stop right there because there's no opportunities. Well, here's the way to think about it. We're being asked to pay, or actually, let's just say that the way to look at it is that each British pound can be traded for 240 yen instead of the 220 yen that are consistent with the other 2 exchange rates. Okay, now what does this tell us? This means that we should use pounds to buy yen. To buy yen, because each pound can be traded for too many yen. This will be the source of our arbitrage profits. All right, so that's the key to the whole thing. We want to be in a position to trade British pounds for yen. But how do we get our hands on those pounds? Very interesting. Good question. What we have to do is trade our dollars for pounds. So the exchange rate here is $2 per pound. And so what we're going to do here is take our $1 million and divide by $2 per pound. And that will give us 500,000 pounds. All right, so right now we have in our possession 500,000 British pounds. And according to that incorrect quote we were given, we can now trade these for 240 yen per pound, which is what we will do. And so therefore, in this case, we're going to multiply. 500,000 pounds will now translate into 120 million yen. Okay, so I'll put that right over here. And now we can bring these back to the United States. And the exchange rate here is 110 per dollar. So here we'll divide. And this works out to be $1,090,909. So when we bring those yen back to the United States, we have $1,090,909. So guess what? We made money. So the arbitrage profit here is the difference between the two, of course, which is 90,909. And that didn't take long, did it? We just really picked up the phone and made 3 simultaneous transactions from other dealers, or else we did it through the computer. But anyway you look at it, we made money because the cross exchange rate over here is inconsistent with the other 2 exchange rates. It was too high. Now, if it had been too low, let's say instead of 220 it was 200, then we would have made money by going in the other direction. We would have gone to Japan first, back to England, and then back to the United States, and that would have given us a profit. So as long as the cross exchange rate is not equal to the one implied by the other 2 exchange rates, that means there's an opportunity there to earn triangular arbitrage profits. Also, a helpful hint here is if you go around the triangle in the wrong direction, when you get back to the beginning, you'll find yourself with a loss, which you can then reverse by just going in the opposite direction. Okay, so suppose that happens to you while you're working on the exam, just start all over again. Go in the opposite direction, and you'll find that you have indeed made money. Now, if this cross exchange rate here, though, had been quoted correctly, if this had been 220 yen per pound, you can see up here, we would not have had 120 million yen. We would have only had 110 million yen. And that would have translated into exactly 1 million US dollars. So if you go around the triangle and you have no money, no profits at all, that just means that the quote that you were given was actually correct. All right, most of the time, that's exactly what will happen. All right, so that was that. Now let's try this one. This is, of course, in covered interest arbitrage. You can tell because we're given forward exchange rates in the problem. So here we're looking at not dollars and pounds, we're looking at dollars and Swiss francs. So we start out with the Swiss franc dollars exchange rate of 78.06 cents US per Swiss franc. Now, 3 months forward, which we will actually treat as 90 days. Remember, this is a 3360 market where you've got 30 days in a month, 360 days in a year. So 3 months will be replaced with 90 days. They mean the same thing in this market. The 3-month forward exchange rate is 7834. And these are the respective euro currency interest rates that are paid to dollars and Swiss francs. So the first job we have is to figure out whether or not this forward exchange rate is consistent with these other variables, the spot exchange rate and the 2 interest rates. How do we do that? Well, here's our formula. Okay, so let's remember what these variables mean. R is the euro, in this case, euro dollar rate. R star is the euro Swiss franc rate. N is 90 days. E, of course, is here. And we're solving for F. Okay, we're solving for the implied forward exchange rate, the one that is consistent with this interest rate parity condition. Okay, this is the one, this gives us the only value of F at which arbitrage opportunities will be avoided. All right, so let's do some substitutions. So E is again 7806. Now here we have 1 plus 4.8%. Let's write it as a decimal. And this will be multiplied by 90 over 360. Here we have 1 plus 0.032. Oh, whoops, my mistake. I just realized I put the parentheses in the wrong spot. Okay, so this is what we need to do. Now, let's simplify it a little. Okay, now, obviously 90 over 360 is 1/4. So what I can do to simplify this is multiply these together to come up with 0.012. And here I have 1 plus 0.008. So now I can throw this into my calculator and let's see what we get. So that works out to be, taking it to 4 digits after the decimal, I've got 78.37 dollars per Swiss franc. Okay, now of course that's not equal to what they gave us though, is it? All right, so that's the rate implied by the interest rate parity condition. But sadly enough, the one they quoted us is 78.34, which means we have an opportunity to make arbitrage profits. The question is how? Well, here's the way to think about it. At this exchange rate, or actual, let's put it this way, the actual forward exchange rate. It is possible to use dollars to buy forward Swiss francs too cheaply. In other words, it's almost like the francs went on sale. Therefore, we will buy Swiss francs in the forward market. In other words, we will enter, somewhere along the way, we will enter into a forward contract to buy Swiss francs for 90-day delivery at only F equals 78.34, when it should have cost us 78.37. And that's the source of our arbitrage. We're going to enter into a forward contract to buy Swiss francs for delivery and only pay 78.34 for them. Now, if you look at the diagram that we used last time, we have to figure out how to do that, though. There's only two ways we can really go about this. We can start out with dollars, or we can start out with Swiss francs. Okay, so let's see if we can figure out what we should do. Let's draw the picture, and let's figure out where we should go. Now, in the upper left-hand corner, we have dollars. And so let's assume that we're looking at $1 million. Now, either way, any way you look at it, the spot exchange rate is 78.06. That being the case, if we start with dollars, we will convert them into Swiss francs by dividing. Okay, here we have to divide. So we'll have 100,000, or 1 million rather, over and so that leaves me with 1 million divided by 0.7806 is 1 million. 281,000 065. Let's round this to 066. So we don't know just yet if we're going to be borrowing the Swiss francs or if we're going to borrow the dollars. So, but we do know that if we want to use $1 million, we'll put those in the top. The equivalent number of Swiss francs is 1,281,066. Now, no matter what happens, one of these currencies will be invested and the other will be borrowed. So what we should do now is figure out how much interest we'll either earn or pay in both of these cases. So remember, this is only 90 days. The US rate is 4.8%. And down here, Swiss franc rate is 3.2%. So how much, whether we borrowed or lent, how much would we have right here? Well, $1 million is multiplied by, just like we had before, 1 plus 0.048. Oh, I'm running out of space. All right, let's try that again. And so that's going to be $1,012,000. Down here in the Swiss franc market, whether we borrowed or lent, we would have 1,281,066. Okay, 3.2%. And so when you multiply that out, the number of Swiss francs becomes 1,291,315. Now, the forward exchange rate that we were quoted is 0.7834. Now, we did realize earlier, we figured out already that we want to buy Swiss franc in the forward market. What that means then is that what we need to do is somehow wind up with dollars that we can then use in a forward contract to buy Swiss francs. So that means we're going in this direction. So in order to acquire these dollars, though, we're going to start out with a spot Swiss franc. So we're borrowing this many Swiss francs. We go up, bring those Swiss francs into the euro dollar market. That gives us $1 million US dollars, euro dollars, which we then invest for 90 days at 4.8%. And in 90 days, this is the balance in our euro dollar account, $1,012,000. In 90 days, we can deliver those dollars through this contract and accept Swiss francs. How many Swiss francs will we receive from this contract? Well, for that, we're going to divide 1,012,000 divided by 0.7834 works out to be 1,291,805 Swiss francs. Now, the way this works, this now is our money. We have acquired 1,291,805 Swiss francs. But this Swiss franc loan down here that we started out with has to be repaid. So this is our repayment of the Swiss franc loan. So the bottom line is these two numbers. This is what we collect from our contract, and this is what we pay for a loan. And so you see, the difference between those two is our profit. All right, so in other words, we receive 1,291,805 Swiss francs from the forward contract. We pay 1,291,315 Swiss francs to repay our loan. The difference of 490 Swiss francs represents our arbitrage profit. So the bottom line is we did make money by going from the bottom left-hand corner down to the bottom right-hand corner. All right, and so that is coming from the fact that we borrowed Swiss francs, converted them into dollars, deposited them in a euro dollar account. We entered into a forward contract to buy Swiss francs for our dollars, and then we repaid the Swiss franc loan with the proceeds. And there were 490 Swiss francs left over. That's our arbitrage profit. And again, it doesn't sound like a lot, but what if we'd started out with not $1 million, but let's say $1 billion? Whatever we can easily magnify the size of our investment because it is a risk-free profit. And any way you look at it, a risk-free profit is a risk-free profit that we want to take anytime it's available to us. It's really no different than walking along and finding a $20 bill in the ground, which clearly doesn't belong to anyone. What do you do with it? You stick it in your pocket, and that's your arbitrage profit. All right, so now that one's done. So now the rest of these are basically graphs that illustrate the asset market model approach to exchange rate determination. So let's see what we're being asked to do here. All right, so first we need room to do this. Okay, so let's see. Let me split the screen so I can keep an eye on what I'm doing. All right, here we go. All right, so here's the graph. So what do we know? Well, we've got the UK rate is 5%, the US rate is 3%, the expected exchange rate is $2. So the equilibrium exchange rate is 1 plus the US dollar rate minus the UK rate. So we're going to have $2 in the numerator, and then we divide that by 1 plus the US rate minus the UK rate. So what you've actually got here is $2 over 98 cents. Okay, so that ratio is 2.04, let's say. That's close enough. All right, that's our equilibrium exchange rate. How do we find this on the graph? Okay, so we have the exchange rate on the vertical axis. Percentage rate of return is on the horizontal axis. The US rate is vertical. That's at 3%. And then the return to the foreign currency is here. And we have an equilibrium exchange rate of 2.04. So that's the starting value. Now they tell us that investors become more pessimistic about the future value of the dollar. EE rises to 202. So let's recalculate this. So the denominator hasn't changed. So all we have to do really is change the numerator. And so if you plug that into your calculator, you'll get 2.06 approximately. So let's keep the same graph for this. So the expectation is what's changed. So this one will shift up. We can call this 1 and 2. And we now have an equilibrium exchange rate of 2.06 per pound. All right. Okay. All right, so we don't need to split the screen anymore. That's what it ultimately looks like. So of course you can see that this curve shifted this way to reflect the more pessimistic view of the dollar. And the result is that the dollar did get weaker, as we predicted. All right, so that's pretty straightforward. Now, how about this one? We have, now this time it's dollars and euros. So the equilibrium exchange rate will be it's always 1 plus the dollar rate minus the UK rate, or in this case, the foreign rate is the euro. All right, so we'll have 130 in the numerator. Here we have 1 plus 0.03 minus 0.04. And that means we have 130 divided by 0.99, and that equals 1.313. And that, of course, means dollars per euro. All right, so we'll show this with a graph. Let's see if I've got room here. Yes. So the US rate is 3 again. Here we have our euro. And where they intersect, we have our equilibrium exchange rate of 1.313. Now they tell us that the Eurozone engages in expansionary monetary policy. The Eurozone rate of interest falls to 3. All right, so what's going to change is this number right here. So we'll have EE. We'll just plug these directly in. 1 plus 0.03 minus 0.03 equals 1.3 over 1. So the dollar got stronger because the Eurozone lowered their rate of interest. Okay, so that would be this case. Okay, and so as we would expect, the euro got stronger because Eurozone rates went up, or down rather, and for that reason the dollar just got stronger because investors are shifting some of their funds from these euro accounts and euro LIBOR they're called, and back into euro dollars. Okay, now how about this one? Show graphically the impact on the equilibrium rate of interest in the US if the Fed engages in expansionary monetary policy. All right, so that's a different graph. We have oh, sorry, this is the wrong one. Here we have the vertical axis is R, the horizontal axis is Q, This is the real money supply. This is the real money demand. Here's the equilibrium rate of interest. We'll call it 0.1. And then what happens is the Fed engages in expansionary monetary policy, which means the money supply goes up. And as a result, the US rate goes down. And that's exactly what they were aiming for. Okay, so that's a change in monetary policy. Now, in the second case, they're asking us what happens if GNP rises. All right, so in this case, it's not monetary policy that's changing. It's the demand for money. It is the demand for money, but indirectly through the change in GNP. Okay, so how that works here. Oh, sorry, wrong one again. I'm so used to that graph. So that's the real money supply. Now, what's happening differently here is this. We've got an increase in real GNP. And that means that the money demand goes up. Okay, so this curve shifts now. Instead of the money supply curve, it's the money demand curve. From Y1 to Y2, at the new equilibrium point, we have 2, R2. So because real GNP increases, US rate of interest goes up. So since real GNP increased, the real demand for money also increased, and therefore the US rate of interest also increased. That's what happened here. All right, one more. Show graphically the impact on the equilibrium exchange rate between the dollar and the pound if the Fed engages in contractionary monetary policy. All right, well, that should be pretty straightforward. We're back to the equilibrium exchange rate diagram, though. That's right. This is the dollar and the pound. Okay. All right. So expansionary monetary policy means that the US rate is falling. All right. So therefore, the real money's. Oh, wait a minute. Whoops. I just remembered. This is supposed to be R. Sorry. The money supply is going on behind the scenes. My fault. So Sorry, this is $1, our $1. Now, again, the Fed engages in contractionary monetary policy. So the rate rises. And this curve shifts to the right. And as a result, the dollar gets stronger. Okay, so a higher US rate is good for the dollar. All right, let me just mention this in the bottom. As a result of expansion, wait a minute. Let me make sure I didn't do this backwards. No, it's contractionary. Contractionary monetary policy. US rates rose, and therefore the dollar became relatively more attractive than the pound to investors. Investors shift funds from pounds to dollars, and the dollar appreciates. Perfect. All right, so that's it. We're done with that one. So I'll post this later on tonight or tomorrow, and you'll be able to use it as a guide to doing the actual midterm, which I'll post as well. It's not going to be this long. This is meant to be like a little bit of everything. So yeah, we got a lot done there. Anyway, so what we can do now is get back to 16, which we really just barely started last time, where we're looking at the long run. So the behavior of exchange rates can be expected to be different in the short run and in the long run. Because remember, we did say one time, in the short run, prices are assumed to be fixed. And in the long run, they're assumed to be flexible. Okay, so let's do this. Uh-oh, what just happened? There we go. All right, hold on one second. My computer was freaking out for a second there. Okay, so in the long run, well, yes, in the short run, we've already said the short run is the time frame when prices are fixed. In the long run, prices are flexible, which means inflation can change. So, but in the short run, we're assuming that foreign currencies are held almost exclusively in order to earn the highest possible return from foreign assets. In the long run, though, the primary focus is on buying foreign goods and services. So therefore, the focus shifts to which country's goods and services are the most competitive in world markets. In other words, who produces the best goods that people actually want to buy at a reasonably low price. So whoever has the most attractive goods in the market should, in principle, have the strongest currency. All right, so we introduced the concept. Oh, we're going to introduce the concept of the real exchange rate. We started to look at these parity conditions, which are really not parity in the same way that interest rate parity is. In other words, these are not conditions that can generate arbitrage profits if they're violated. These are just relationships that are thought to hold in the long run. Now, I've already seen that purchasing power parity itself doesn't seem to work particularly well because it's based on a lot of very strong assumptions. So, for example, well, first note that there's two different versions of purchasing power parity. This one is sometimes known as absolute PPP, as it's called. And in this absolute PPP version, exchange rates are determined by price levels in two countries. And when I say price levels, what I really mean is the index that tells us what the cost of living is in each country. So, as we've already seen, In the US, that index is the CPI, or Consumer Price Index. And in England, and we explain what it is. It's the price of a basket of goods that is what the BLS thinks is typically bought by an urban family of four. And the UK version of this is called the RPI, or Retail Price Index. So each country has a representative basket of goods, and it's the cost of those goods that, according to PPI, is what determines the exchange rate between the two countries. So what they're basically trying to claim here is that the cost of a basket should be the same in both countries after adjusting for the exchange rate, which implies that the exchange rate itself is determined uniquely by the relationship between the two countries' prices. Now, this is all based on the notion of the law of one price, which means that all goods should sell for the same price in all markets, and we call that the law of one price. So here's a quick example that we looked at. If gold sells for $800 an ounce in the US, when the exchange rate is $2 per pound, it stands to reason that it should only take 400 pounds to buy an ounce of gold in the UK. But what if the price is different? What if it's less for some reason? It could be any number less than that. How could you make profits? Well, you buy the gold in the UK because it's cheaper than in the United States. You then turn around and take the gold you just bought and resell it in the United States at the higher price. And then, of course, the difference goes in your pocket. Now, by the way, unlike arbitrages that take place with financial assets, when you do arbitrage with physical goods and services like this, there's likely to be fairly steep transactions costs, like shipping an ounce of gold from one country to another, that type of thing. So that's going to interfere with this process to a certain degree. So it just means that in order to make an arbitrage here, the discrepancy in the prices in the two countries has to be more than the cost of shipping the gold back and forth between the two countries. So therefore, the arbitrage can still happen, but it has to be more than a certain minimum amount to make it worthwhile because of the transactions costs involved. You don't have to worry about this with financial assets. Okay, there's no physical presence with a financial asset. It is simply an entry in your account. There's nothing to move back and forth across borders. It's just a change of numbers in two individuals' accounts that's happening when one person buys a financial asset from the other. But anyway, the logic is exactly the same. You're always buying something that's underpriced and selling something that's overpriced to make arbitrage profits. Okay. So here, though, you can see, though, this process can't last for very long, because when people notice this and they start buying gold in the UK, they start selling gold in the US, the price of gold in the US goes down, the price in the UK goes up until they're equal to each other. And then it all stops. And then once again, the law of one price will be reestablished. And everybody's happy. Now, of course, if the opposite happened, if the gold was more expensive in the UK, then we do the opposite. We buy the gold in the United States, we sell it in the UK where it's more expensive, and then we put the difference in our pockets. And naturally enough, this can't last forever either, because what's happening now is that people in the US are pushing up the price of gold by buying it, and people in the UK are pushing down the price by selling it. And fairly quickly, the law of one price should be reestablished. Okay? And so this process, because it involves physical goods, is often called goods arbitrage to distinguish it from financial arbitrage, which is what we've been doing up to this point. For example, triangular arbitrage, covered interest arbitrage, those are financial arbitrage types of financial arbitrage. Here, this is an example of goods arbitrage. Now, the problem with the law of one price is that there's many cases where it may not hold. Just as a classic example of that, perishable goods. So if we find out, for example, that a Big Mac is $3 in the US and £2 in the UK, when the exchange rate is $2 per pound, that implies that the UK Mac is more expensive. So therefore, in principle, it should be possible to buy Big Macs in the United States and ship them overseas and sell them in England for $4 or £2, I should say, or the equivalent of $4. The problem with that is that the Big Macs are perishable, so they'll be worthless when they get there, and the cost of shipping them overseas is far higher than the price discrepancy. So goods like this, where it makes no sense to ship it back and forth, are called non-traded goods. The gold is different. The gold is easy to ship overseas. It can't spoil. And gold is the same quality in every country. So that's different. This is a situation with a perishable good, which means that the prices can be very different, and they typically are, because there's no way to earn an arbitrage from those price discrepancies. So the existence of these non-traded goods is going to make it much more difficult for a PPP condition to hold. All right, PPP in principle can only hold if every good is subjected to the law of one price. All right, now also, when you think about it, services cannot be traded either, because the service needs to be done in the local market. Like, for example, legal services. You can't buy legal services in London and resell them in New York. It doesn't work that way. So services basically can't be traded at all. And we also have all these non-traded goods. So as you probably know, the US economy, at least, is becoming progressively more and more of a service economy. And so the percentage of GDP that comes from services is growing all the time. So in other words, the percentage of our GDP that is either non-traded or as a service is getting pretty high. So the law of one price is applying to fewer and fewer goods. And so the end result is that PPP is highly unlikely to hold in practice. So therefore, it's not likely to hold, but let's just see what it claims. PPP claims that if we just take the simple ratio of the price indices of two countries, let's say the CPI in the United States and the RPI in the UK, that ratio should equal the exchange rate between the two countries. Here's the formula, and it can be written in a couple of different ways. Well, first let's look at the formal definition. E, the spot exchange rate in dollars per pound, times the UK price level should equal the US price level. So we can rearrange that algebraically and show that the spot exchange rate should be nothing but the ratio of the CPI in the US to the RPI in the UK. And it's that simplistic. Now, one good thing about this is that it has one very important detail, that it's very realistic. It does predict the following, which is perfectly sensible. In fact, let me type this in here. According to this theory, then, since E equals P over P star, this means that rising US prices will cause the dollar to depreciate. Rising UK prices will cause the dollar to appreciate. Okay, and you can see why, because if the US price level goes up, P will go up, therefore E goes up, which means a weaker dollar. But if P star goes up, that means you're increasing the denominator the entire ratio falls and you'll have a stronger US dollar. Okay. Now, but of course, this PPP condition is based on the assumption that the law of one price holds for all goods and services. And to the extent that that's not true, then PPP is not likely to hold. Now, here's an interesting side note. The Economist magazine, which you may have heard of, many years ago, they came up with this idea. They said, why don't we try this? Why don't we see if PPP holds by comparing the price of a Big Mac in the United States and the UK? And we're going to find out if it really works or not. Now, in the time that they decided to introduce this idea, it was meant to be only taken semi-seriously. And so here's what they actually do. They figure out what the Big Mac would cost in another country if PPP actually holds. If PPP was for real, the Big Mac should cost the same in every country in the world. But you can see, like here's an example. As of last December, a Big Mac cost 3.29 pounds in Britain and 5.66 in the US. Now, this exchange rate is pounds per dollar. So the actual exchange rate at that time was 0.74, which is the same thing as saying $1.35 per pound. So if you multiply that by the British price, that means the cost of the Big Mac in England is only $4.46. Okay, in the United States, of course, it's 5.66. So according to PPP, the British pound is 21.6% undervalued. It should be selling for a higher price according to PPP. Now, for other currencies, it could be the other way around. Those currencies could be overpriced based on PPP. So what they do every year is they print this chart to show you where these currencies stand relative to where they should be with PPP. And you can see virtually all of them are undervalued according to PPP. And in fact, it's not even close. Look at these percentages. Israel is only 5.5% under, but look, it keeps going up and up and up, and it goes as high as 68.7% for Lebanon. Okay, so this article explains how this works. In fact, you know what I'm going to do here? Let me send you a link to this thing so you can read it and get a better sense of what this is all about. I'll stick this into the chat room in case you want to read this article and understand what exactly they're doing there. And in fact, it's very possible that on YouTube, we can find a good video which explains this in more detail. Why, what do you know? There we go. I'll tell you what, why don't we watch this? Because I think it'll make this make a lot more sense. So, all right, let me just quickly grab this. Oops. Now, I'm going to send you, it's very short, but at least it'll tell you what's going on. I'll send you this link so you can watch it on your own computer. If you try to watch it on my computer, you won't be able to hear the sound. All right, so I'll send it off to you. Now, in the meantime, I also have to turn off the screen sharing because we don't want to have any copyright issues. So why don't you watch the video on your own computer? the one that appears in your chat box, and then in a few minutes we'll get back together and we'll go over it. All right. In the meantime, I have to turn off the sharing. So let's watch this thing. All right. Well, that was okay, I guess. Wasn't maybe as sophisticated as I hoped it would be. There's I found another one here. Maybe we'll check this one out too while we're at it. Hold on one second. Oh, wait a minute. Wait a minute. I'm trying to make a note of this link and I keep losing the page. Hold on one second. The Big Mac Index. Okay, I found another one that looks like it might be a little bit more advanced, which is kind of what we're hoping for. This is Big Mac Index Explained. Okay. Hold on one second and I'll post it in the chat room for your enjoyment. All right, here we go. Let's check this one out. Okay. Now it turns out that there's other fun price indices that have been created. I thought you enjoyed this one. It's meant to be a goof, but I think you would appreciate this. So I'm going to send it to you without telling you what it is, and you're going to tell me how much fun it is. But it's not that unlike the Big Mac Index, but it's based on something completely different. All right, hold on one second. All right, so I'm going to fire this off to you in the chat box, and then we're going to watch this. And this one is meant to be fun. All right, let's check this thing out. All right. Well, I don't know. Did you find that to be amusing? Well, I did. Okay. It's kind of fun. It's not radically different. So what you could actually do literally is figure out what the exchange rate should be between two different countries just by calculating how much it costs to buy the 12 days of Christmas in each of those countries. We're not going to actually do that here, of course. All right. So let's see. Where did we leave off here? Let's get that sharing back on. So, oh, that's right, the Big Mac Index. So here's a few other reasons for this. Now, it turns out that there's the three other parity conditions we want to look at. The first one is actually based on and it's closely related to purchasing power parity, but it is slightly different. It's called relative purchasing power parity. And then we have two others as well. So since it's getting a little late here, why don't we make sure we have our break tonight? And when we get back, we'll carry on and go over these other conditions that are supposed to hold in the long run between exchange rates. And we'll see some of these make a lot of sense and some of them do not. All right. So let's knock it off for a bit. And when we come back, we'll go over this in more detail. All right. So let's get back to it. So anyway, relative PPP is a somewhat more realistic version, as it turns out, of absolute PPP, because now we're thinking in terms of not levels of prices, but changes. And so basically what we're saying here is that in PPP, relative PPP, the changes in exchange rates are driven by inflation rates, okay? Because the percentage change in a price level is equal to the inflation rate in that country. All right. So what this theory implies is that countries with high rates of inflation should have weaker currencies and vice versa, which makes perfect sense. Inflation is one thing that investors like to avoid because it reduces, of course, your purchasing power. And so countries with high inflation rates will tend to have the weakest currencies. And so this theory is trying to explain why that's happening. So if you look at the PPP condition, E equals P over P star, you can convert this mathematically into this expression, which shows us that the percentage change in E, this is a special shorthand notation. You recall that delta, the Greek letter delta, simply means change. And then when we attach a percentage sign to it, it becomes a percentage change. Okay, now this equals the percentage change in the domestic price level minus the percentage change in the foreign price level. This first term is nothing but domestic inflation. And this is foreign inflation. So the difference between the two will determine what will be the impact on this exchange rate. All right, so let's look at some examples. Suppose, for example, the spot exchange rate between the dollar and the pound is $2. The US inflation rate is 2%, the UK inflation rate is 4%. Now, based on what we just said, this implies that the dollar should appreciate against the pound because the US has a lower inflation rate. Therefore, its purchasing power is falling slowly, more slowly than the UK pound's purchasing power is falling. So the dollar should be appreciating against the pound, which of course means that the pound is depreciating against the dollar. The theory is telling us not only that, but it's telling us by how much. So let's say, for example, here's the actual relative PPP condition. So this would be the US inflation rate. This would be the UK inflation. And so because our inflation is lower than the British inflation rate, this means that the exchange rate should fall by 2%, which is the same thing as saying the dollar should appreciate by 2% against the pound over the coming year, that is. These are annual numbers. Okay, so in other words, the dollar should gain 2% against the pound over the coming year because of the differential in their inflation rates. So if, for example, now here, remember, we said that we started out at $2 a pound. 2% of $2 is 4 cents per pound. So the theory predicts that if nothing else changes, by this time next year, the dollar should be at $1.96 per pound. In other words, it'll be 2% stronger than it is now. Now, by the way, I do want to point out here an important detail. If the exchange rate that we're looking at is quoted as units of foreign currency per dollar, then we would write it this way. Okay, so in other words, for dollars per unit of foreign currency, the condition, or let's say dollars per pound, the condition is written as P over P star. When it's written as so many units of the foreign currency per dollar, then we have to rearrange it algebraically and it becomes P star over P. So I just wanted to point that out. We've been focusing all of our attention on exchange rates where we have the dollar per foreign currency, specifically the pound, but sometimes we may run into another situation, like, for example, yen per dollar. And if that happens, we have to be careful because then the condition is written in the following way. They both mean the same thing, but we just have to be careful to apply the one that works. And then the relative PPP will change as well. So if it's dollars per unit of foreign currency, then our relative PPP will be written the way we just saw it. Actually, sorry, this is that. But if it's not, then we have to change it. So in fact, I will put that right here so you can see them side by side. If instead it's foreign currency per dollar, then you'll write this as, basically you're just reversing them. The percentage change in P star minus the percentage change in P. And again, just in case it shows up, I usually end up just using all examples with dollars per foreign currency anyway, but just in case, you never know, we should be aware of the fact that we would have to change this condition to reflect the fact that we're looking at foreign currencies per dollar. All right, so that's enough for purchasing power parity. Now we're going to look at something called the Fisher effect, which there's a domestic version and then there's an international version. The domestic version is very simple. It basically just says that the nominal US rate of interest equals the real US rate and the inflation rate. And remember, the real rate, the real anything for that matter, has been adjusted for inflation. The nominal has not. Okay, so the nominal rate, remember, is the one that has not been adjusted for inflation. So Irving Fisher actually created this. He was a very famous economist. In fact, I have a very brief biography of him right here. Let's just take a quick look at it. This is Irving Fisher. Now, Fisher is an interesting character because he was an academic, but he also understood business very well. He was the very first person ever to be granted a PhD in economics by Yale University. He actually taught there for a while. He wrote a very influential book called The Theory of Interest. He thought that it made more sense to have a consumption or sales tax instead of an income tax. He was one of the first to create the idea of price indices. So like the CPI, for example, wouldn't have existed if it hadn't been for the research of people like Irving Fisher. And he invented this archaic device called the Rolodex. Now, in case you've never seen one of these things, let me get you a picture off the internet. And you can see it's basically set up for these little note cards where you can write down people's names and addresses and spin through them when you need to look them up. So you can guess that these were obviously they were made redundant by the rise of computers. But my guess is that you can still buy these in case you want, like, look, these are for sale. Look at this. You could buy this one on Amazon. If this is how you want to organize your information, this is just great. In fact, people used to keep recipes on these things. You would write down by hand on one of these little cards, one of these index cards, your recipes, and then you would have them in this little Rolodex, and you could spin through them and find them when you needed them. It was pretty convenient, but of course, let's face it, it's sort of outdated now. But Fisher made himself a lot of money with this idea. So he was both an academic and a successful businessman, which is kind of unusual. You don't normally see the same person being good in both fields. So he's one of our great American economists from the early 20th century. And so he's the one who came up with this idea that nominal rates can be decomposed into the real rate and the rate of inflation. That was his idea. So that's why it's called the Fisher effect. All right. Now, we can extend this to the international sphere by noting the following. We're going to claim that we have this condition holding in both countries. What we're going to do, though, is assume that real rates are the same in all countries. It's kind of a strong assumption, but we'll assume that real rates are the same in all countries. So that the implication of that is that the only way that one country's nominal rates can be higher than another's is if they have a higher inflation rate. So here, for example, it says that if these two are equal, then if R1 is greater than R2, that can only be true if the inflation rate in country one, and this is a mistake, of course, is greater than in country two. Whoops, no, that's not what I wanted to do. Hold on one second. So why does that matter? Because up to this point, we've been assuming that when a country's interest rates are higher than in other countries, that makes the currency stronger. But the implication of this is that because a higher nominal rate implies a higher inflation rate, that means, let's see, let's add this in here somewhere. All right. So since a country with a higher nominal interest rate is assumed to also have a higher inflation rate, in the long run, that is. This means that in the long run, the countries with the highest nominal interest rates will also have the weakest currencies. Now, of course, this directly contradicts what we've seen in the short run. We've seen that asset market model that we've spent so much time with is based on the idea that when a country's interest rates go up, its currency should appreciate because people will invest in that currency. This is the long run, though, when we're assuming that the primary motivation for holding a currency is not to invest in that currency, but to buy that country's goods and services. So inflation makes that more difficult. It makes that country's goods more expensive. So in the long run, when the focus is more on goods and services, the higher a country's interest rates, the weaker the currency will be, because the harder it will be to sell that country's goods and services. So here is the opposite of what we had in the short run.
Here, higher interest rates are bad for a currency because it implies higher inflation. Now, of course, if the international Fisher condition is not true, well, then this won't be true either, or at least not necessarily. So the impact of all this is this following condition: the percentage change in E is simply equal to the absolute difference in the nominal rates of interest in two countries. Okay. So instead of comparing the inflation rates here, we're comparing the nominal rates. All right, well, let's take a look at a quick example. Suppose, for example, that the spot exchange rate is $2 per pound. The US rate of interest is 5%, the UK rate is 7%. In the long run, the Fisher effect, international Fisher effect, predicts that because US rates are lower, the dollar should actually get stronger, specifically by the 2% difference between the two interest rates. So that means this is good news for the dollar. A lower interest rate in the long run means that people are more attracted to US goods and services, and as a result, we should have a stronger dollar from people buying more US goods and services, not from investing in US financial assets, but from buying US goods and services. And that means that if we started at $2, of course, that means in a year, the exchange rate is predicted to be $1.96. Now, like these other conditions, this is meant to be an equilibrium relationship. If it is violated, it is not possible to earn arbitrage profits. Okay, this is very different. These long-run conditions do not involve arbitrage. They're what we call equilibrium relationships, which means that they should hold in the long run. There can be temporary discrepancies, but they should hold in the long run. If they don't, there's an automatic tendency for them to drift back towards their equilibrium levels. Now, this might take a while to happen, but it will eventually happen in equilibrium. Oh, and by the way, once more, this, if we have dollars per unit of the foreign currency, then this international Fisher relationship says that we should have this situation. If not, if we have foreign currency units per dollar, then it's going to be reversed. All right. Now, real exchange rates. This is a fairly complicated idea. We've already seen how to convert a nominal variable into a real variable. The logic is that what you're essentially doing is you take a nominal variable and you control for, or you adjust for, the price level in that country. With an exchange rate, to convert a nominal exchange rate into a real exchange rate, we have to take into account not just one, but two price indices. So if, for example, we want to determine the real exchange rate between the dollar and the pound, we have to take into account the price level in the US and the price level in the UK. So it's more complicated than adjusting an interest rate, or let's say GDP, for inflation, because then there's only one price index. Here, there's two of them. And what's interesting here is that whereas the nominal exchange rate is so many units of one country's money per units of another country's money, here we're thinking in terms of baskets of goods, specifically the baskets that are used to construct the price indices in those countries. So the CPI basket in the US and the RPI basket in the UK are what we're assuming will be exchanged when we define the real exchange rate. So it's going to be a very interesting idea. But because it's getting late, and we've gotten a lot done already, I think this might be as good a place as any to knock it off. So tonight or first thing tomorrow, I will post the solutions to the sample midterm. I will post the actual midterm, and you can have until, like I said, April 6th to get that done. And in the meantime, we'll just continue with chapter 16. And then we also need to do problem sets for any chapters that we cover so that eventually we can get ready for a final exam. Now, in this class, the final exam most likely will take place at the end of April. I don't remember the exact date, but it's very late in April typically, or possibly the first week in May. So while that still seems like a long ways off, believe it or not, by the time I see you all again, it's going to be April already. So time is flying. So we have to be aware that at some point down the road, we have to start preparing for a final exam. But in the meantime, let's just work on the midterm itself, and then we'll carry on with this new material. All right. So if there's no last minute questions, I think we should stop right here, and I'll see you all next Thursday. Okay. All right.
Thank you.
Professor.
All right.
Thanks,
Bye.
Professor. Have a good one.
Later. Okay. Bye.
Yeah.